Welcome to part two of our discussion with Steve Christensen about the state of auto finance and the auto industry in general. We hope you enjoyed part one, and now here's part two.
The finance industry is turned against itself. Okay. When I got into this business all those years ago, if you had a repo within the last 12 months, you could not get financed. You were immediately declined, period. Right. Where now, what we're seeing, because we talk to our dealers regularly, they'll send us an application and we'll look at it and we'll be like, what's up with this open auto loan that's now past due? Oh, well, the lender just picked that one up. That's a repo. They don't have it anymore. It just got picked up last week. Now they need another car. So wait a minute. They just got that car repoed a week ago, and now they want a replacement car. Yeah, that's what's going on. Well, the car was bad. The other dealer sold them a bad car. It wasn't the customer's fault. They couldn't afford the repairs. They struggled and struggled and struggled with it, and it wasn't really their fault. It was just a bad car. But this is a good car, and it's going to be better now. And that repo was just like a week ago. And so we're looking at that and we're talking to the dealer and we're like, well, do you have any other approvals? Oh yeah, we got 3 other lenders that are already approved this. We just want to see if you'll do a better rate. It's like, are you kidding me? There was a time when that mattered and it doesn't anymore. And this is in part driven by the fact that lenders, like I said earlier, can't let their portfolios decline. They must originate or they will fail. Okay. And so as a result of this, if I'm competing against you as another lender, there used to be this sort of honor among thieves, right? Where if you're the finance company of this customer and and in the customer let the car go and you're repossessing it, we're out. We're not going to finance that customer until they prove their worth again another way. Where now the industry just doesn't care. They're going to pursue that new financing and they're just going to mitigate the risk via pricing, which is not good for you, by the way, as the consumer, because your interest rate is going to be a lot higher than you've ever seen before, and away it goes. And it's just, made worse by there was a piece of legislation that passed a bit ago because there was a time, and we still do this. We're one of the few finance companies that will pursue a customer post default, meaning we will take them either to small claims or civil court and we'll pursue them for the deficiency balance post repossession. Let's call it $10,000. We're going to get a civil judgment against you that you still owe us $10,000. And a civil judgment may be on your bureau for 10 years, and we can renew that, by the way. But then after you get the civil judgment, I can go after your bank account. I can do a wage garnishment, all kinds of things once you get the judgment. And so as a finance company, if you apply for financing with us and I pull your credit and I see you got a civil judgment with a competitive lender from only months ago, I'm like, your income is at risk. I'm not sure I don't think you're a good credit risk because you have a recent judgment with another auto lender. And I am worried that your income could be severely hamstrung due to a wage garnishment or something. Our government decided it was a good idea that civil judgments or judgments in general no longer appear on credit reports. So you could have 9 judgments against you and it's not going to be on your bureau.
Now, is that related to the Consumer Financial Protection Bureau and the legislation that created that post-Great Recession?
I don't know exactly when. I want to say that came to pass somewhere around 2017. Whether it was the CFPB behind it, I do not know.
Yeah, CFPB didn't get created until I want to say 2021.
Yeah, I don't. I can't say exactly.
Oh no, CFPB predates 2021. It came out of the Great Recession.
But the point is,
well, it didn't have Elizabeth Warren behind it until 2021 because it was her baby. And so the Great Recession, there were definitely some safeguards that were put in, but it wasn't the same thing. Now, Steve, I don't know if you're talking specifically about a California law or if that was a national law.
I believe it's national.
Okay. I have a feeling it's pandemic. So the
thing about that, just let's pretend you're a subprime or non-prime borrower, Rob, And you've had two repossessions before, and nothing bad happened. They charged off the deficiency balance. Um, they didn't pursue you. They might have called you for a little while, but from there, nothing happened.
Right.
And you apply for another loan and you got approved within 30 minutes by another competitive lender. So if you think about this for a second, we've retrained consumers to not care. You had a loan, something went wrong with the car. You're going to say it's not your fault, you know, probably never changed the oil, you know, who knows? Or legitimately the dealer you bought it from was just a bad dealer and they didn't do a good job reconditioning the car. They both happen. You either got irresponsible owners who aren't maintaining the car or a legitimately good person who just bought a bad car. Either way, it's the same thing. It's bad car equals bad loan. So you let it go and nothing bad happened. And you got another loan minutes later. The question comes down to is, why do you even care? The argument I've made to the members in our finance association is, well, guess what? People aren't buying these cars. They're renting them.
Right.
That's the philosophy. That's the mentality. They're not buying them. They will make the payment for as long as it suits them. And what no longer suits them, they cast it aside. They call our repo department and say, you can come get your car. I don't want it anymore. That's exactly what they say. And we pick it up, we take it to auction, and we move on. And these people already get another car. We've had people drop cars off here as a voluntary surrender, and we talk to them about, well, is there a way we can mitigate this? You know, what if we kind of help you out with repairs of what you need, or what? Let's talk about this. That's okay. I already got another car. We hear that constantly. You know, it's so with that kind of thing going on, you know, choose your poison. Is it the cost of eggs? Is it the cost of insurance? Is it the cost of fuel? It's all of it. You
Right.
can't, if you fix one thing, who cares? If you can't fix all of it, none of it's going to matter.
Well,
That sounds
exactly.
a little dark, but that's just my opinion.
No, I get that completely, and it's more it's what's called moral hazard, where people stop seeing a downside for bad behavior or investing in the housing bust, which we saw in 2007, 2008, in all the way to 2010, 11, was
The short sales.
people when they were buying houses in 2004, 2005, they were using loan products that didn't require documentation of income, in some cases, jobs,
All right.
assets. You could have bad credit. It was the old fog a mirror, get a mortgage.
Right.
And so people didn't really see a downside. So instead of just buying one property, and we saw this with quote unquote investors, instead of buying one property with 20% down, they bought four properties with 5% down.
Right.
And it's the old, oh, I'm going to use other people's money. And then when things started falling price wise, they couldn't sell the house and get out from under the loan. They just, it's the old jingle mail. They mailed the keys back to the lender and said, I'm out.
Yeah.
Because, but that also happens in investing too, where you get this frenzy, and we in some cases we've seen that in different parts of the market. You know, the like some of the meme coins and that kind of thing, where people just say, "Oh, it's going up. I'm going to jump on the train before it leaves the station." FOMO, and they end up the people who start the coins, you know, and sell them to people, they make out like bandits, and then the little guy is left holding the bag. And so you start having these imbalances in the economy and in the system where people, there's no shame anymore, like you're saying, in having a repo because, oh, I can explain it away. It
Oh,
was
for sure.
it was the dealer, it was, you know, bad luck, it was whatever. So, and as long as there's somebody there willing to extend them another car loan and not make them really suffer a lot of consequences for it, it's like the first time is the hardest, and then after that, it just becomes, oh, I'll drive it
Easier and
until
easier and easier.
it breaks, and then I'll
I
just
remember during the mortgage industry fallout with the short sales, if your next door neighbor shorted their home, they gave it back to the bank and nothing bad happened, you know, and you're like, well, I'm upside down in my house. I don't
right.
want this anymore either. And it just festered.
They were called strategic foreclosures.
I don't know. Yeah, it's so yeah, I don't I think honestly, when you look at I don't really know, about local economy so much, but when you look at the auto industry that has really faded, and you wonder, as a a citizen and looking at our local community, sales tax revenue from the auto industry feeds a local economy, um, second only to probably property tax. Um, and the auto industry is horribly bad, and so you kind of consider that the compounding effect of that, then as to why we're running into issues with funding, keeping our schools open, our police force staffed, and that type of thing. Like I said, I was talking to you guys earlier. We had a customer screaming on in our lobby about a repossession, and he was definitely not right of mind. Our staff called the police 4 times; they never came. Um, we have a real problem, and what the fix is. It's anybody's guess, but from my perspective in the auto space, if we don't start producing new cars again that are affordable, which then feeds a healthy used car market, I don't see this changing.
Right. And that's
Simple.
something that a lot of people don't appreciate about. So we have official inflation numbers that the Bureau of Labor Statistics puts out that are the most common one you hear about is the Consumer Price Index, CPI,
Mhm.
um, which is basically a theoretical basket of goods and services that is measured over time. How much are those prices increasing? And then you have what the Federal Reserve follows, which is called the personal um, consumption expenditure, which is a little bit tweaked and a little bit lower percentage for housing or what have
Isn't
you.
that Rob, the core CPI, where it
Well, no.
strips out energy and
Well,
fuel or something else?
there's something called the CPI, and then there's something called the core CPI, which strips out food and energy. And then the Fed, when it served them, they created super core, which also stripped out housing. But Supercore shot to the moon shortly after they rolled that one out, so they don't talk about Supercore anymore. But then there's a separate measure which is called the personal consumption expenditure, which is a separate. It's called PCE, and it's usually reported a couple weeks after CPI, and it's a little bit less volatile. So um, the the Fed uses that number, but anyway, but it's limited with what it includes in the calculations. For example, what is most people's number one uh, obligation after maybe their mortgage? Taxes. Taxes
Okay.
are not included in the CPI or the PCE. So if taxes always remained constant, then I could believe that inflation has been running, cost of living has been increasing about 2.8%, 3%, whatever you want to talk about. But when you start adding in the taxes and fees and other extraneous expenditures, there are some people who say that when you actually add up, and this is why you see people pulling out receipts from the grocery store from 2019 or 2020 saying Um, I'm paying double what I was paying then.
Right.
And so I've seen credible people estimate that the cost of living today, never mind when inflation, official inflation was at 9%, today is between 6.5% and 7.5% a year. That is how fast prices have been rising. And part of that, and I'm not going to go off on my big rant here, but
Please
part of
do.
that, part of it is because we have gotten ourselves into a situation with our budget deficits and with our future obligations, never mind the year-to-year deficits, our current national debt that's on the books is about 35 to 36 trillion dollars. Okay. Our unofficial national debt, which includes the sum of future obligations of the government, which are things like future Social Security, future Medicare, et cetera, is another $100 trillion.
Ouch.
So our total annual receipts from all taxes is about 5 trillion. So the math doesn't math very well.
No.
And so what the government did back in the early 70s when we went off of the gold standard because too many foreign countries were demanding gold for their dollars. This is back in the day when you could get, I don't remember exactly what the calculation was. It was like 0.2 ounces or something per $20 of actual physical gold. But anyway, we're shipping all our gold overseas. So that was part of what got us off of the gold standard when Nixon repealed that. And but we were having tremendous deficits starting to accumulate. Now back then it was very small compared to where it is now. But with guns and butter, which was the Vietnam War and the war on poverty, et cetera, the Great Society. Anyway, they were looking at these numbers saying there's no way we're ever going to be able to pay for all this. So they got off of the gold standard and they started debasing the dollar. And that's one of the reasons, not the only reason, but that's one of the reasons that a dollar in 1973 or 72, whenever we went off the gold standard, compared to a dollar 10 years later was you had lost 75% of the value of that dollar, what you could buy with it.
Mhm.
And that's had all sorts of societal ramifications. Like you hear the stories about, well, you used to be able to survive very nicely, middle class lifestyle, own a home, have at least one car, if not two, with just one spouse working, usually the man, and the mom staying home with the kids. And by the end of the 70s, early 80s, that was almost impossible for a lot of people, unless you had a really high income. Both spouses had to work just to get by. And so we've kind of continued down that road with a few respites along the way, but it's gotten really, really hard to get by because our incomes just have not kept up with the pace of the cost of living. And this is my last little bit of a rant here, but one of the things that's come out of the Federal Reserve intervening in whether Silicon Valley Bank failing or the great financial crisis or um, there was an event at the end of 2018 when the treasury market started seizing up, and that was a problem with liquidity. So here comes the Fed again and says, okay, we're going to ram interest rates back down. And then the pandemic happens, we go to zero again. So for the people who already owned assets, physical assets, whether it was a home or they own paper assets, which are based on physical assets like stocks, um, we've seen tremendous asset inflation, which has almost outstripped cost of living inflation, which has been great if you already own those things. But along the way, we've created these two parts of an economy where you have people who are in their 40s or 30s or 20s and they look at the cost of a house, cost of a new vehicle, um, being able to put away money for retirement, and they're just saying, I can't. I can't do it. I'll never own a home. I never can buy a new car, whatever it is. And that kind of goes back to this whole mentality of, we've just we've wanted to keep the party going so long. And the government has stepped in too with a lot of fiscal stimulus and higher deficit spending. Our budget has increased because of these continuing resolutions, at least the last few, 8% annually. Well, there's an old rule in finance called the rule of 72. And the rule of 72 is you take a rate of change, either inflation or growth if you're investing, and divide 72 by that number. That's how long it takes to double your money. Well, if we're running 8% increases every year, our budget is going to double. The size of our budget is going to double in 9 years. So every 9 years, we're going to be spending twice as much as we were before, 9 years before. So, but this
That's
is,
called an unsustainable business
well,
model.
that's completely unsustainable. But the problem is nobody wants the party to end, both parties. Neither side has any interest in ending this. They just want to keep papering over it as long as they can. And the problem is, like I was saying before, it used to be the working poor was the bottom, maybe third of the economy. It's now the bottom two-thirds of the economy, especially in a state like California,
Mhm.
where people just they feel like they have a decent job. They what is in their head as what they earn every year. They feel like, oh, I should be able to get by on this, and I should be able to do okay on this and live pretty well. And it evaporates into the ether between taxes, groceries, gasoline. You guys out there in California, I don't know what your tax per gallon is.
Highest in the nation.
Yeah, I know
Thank
it's
you.
highest in the nation, but it just keeps going up. And it's so funny. And I don't like tariffs in general, and there's a tremendous amount of news right now. Well, a tariff is a tax, and it's going to slow down the economy. If we keep these tariffs, it's going to cause us to go into a recession, blah blah blah. But you never hear those same people saying when gas tax goes up by 30 cents a gallon, that's going to knock us into a recession. It's the same thing. It's a drag on the economy because money that was staying in the consumer's pocket or a business's pocket or bank account that they were able to deploy productively into the economy to grow their business, create new products, or just live a little bit better life if you're an individual. Now that's being siphoned off and put into the public sector. And we know that the public sector does a horrible job of efficiently allocating capital. And
Yes.
so it's just very frustrating. It's a pet peeve of mine. You could probably tell what we've done, especially to people who are under the age of about 45, maybe 50 at this point. But people who they seemingly did the right things. They did what they were told they were supposed to do to have a comfortable, successful, contented life and be able to live as well or better than their parents, which is what we were able to do. Um, and that's where faith in the system starts collapsing. And I can hear Steve is voicing his frustration with not just the car market, but because he deals with these people who are working, they need a car to get to work. They just want to live their lives, and maybe they've had some tough times or whatever, but they're trying to get going again. And for all these various different reasons, the auto dealers are getting squeezed, so they've got to put a little less money because it's a survival mode thing, right? They've got to put a little bit less money into reconditioning the vehicles, or they've got to increase their hourly rate for their service techs, and or they've got to tell the customer when they bring their car in for tire rotation or a brake job even. Oh, well, yeah, we found that this is going on with your car, and
We recommend that you do
we
this.
highly recommend it because it might be unsafe. And well, how much is it going to cost me? Well, it's going to cost you $4,500. And people, you hear that statistic that it's something like 70% of Americans don't have $500 in the bank available for an unexpected expense.
Exactly.
And then you take your car in, which you still have about 2 or 3 or 4 years of payments left on that you're already scraping, the money together to get. Maybe you're working a couple jobs. And then they throw that bomb in the middle of the room. And yeah, I could see how people just say, I can't take it anymore. I'm done. Or I don't want to deal with it, so I'm not going to take the car in to get serviced because I'm going to be guilted into thinking that if I put my family in this vehicle, I'm going to kill them. So I don't want to know.
Well, but to break that down a little further, so the question is, like for us as a finance, why continue? Why have we not given up? Well, we believe, or at least I believe, people still need cars. There is no effective public transportation in California in particular. People need cars. There is still a demand for what we do and for transportation. Um, so I think that there has to be a solution somewhere into the future, because people just frankly, there is really no other way. I mean, I think this whole remote working thing has kind of hopefully come to an end, and people start getting back to actually working in physical office locations again. I think that's healthy. But the obvious common sense discussions that we've had is, well, what choice do you have as a consumer, as a person living here? You need a car, so until that changes, I think there is some hope for our future. The question is, I mean, how are we going to get there? I don't know. I think I just think that until we get a healthy supply of vehicle inventories, I don't see costs coming down. Um, but
Well,
until
from an auto industry standpoint, Steve, um, I know right now one of the huge questions is how do we make cars and trucks affordable again?
right,
We did a
And
video on that.
yeah, we did. And that's when you start seeing, um, because right now there are no entry level cars anymore.
no,
But what you're seeing things like a Ford Maverick mini truck. You're seeing things like the Nissan Kicks, which is essentially the old Nissan Versa with a different top hat
remember when
on
Toyota
the
came out with
platform.
Scion, and Scion was just like the brown paper bag Toyota, just basic car. Oh, you want a radio in it? Okay, well, here, that's extra, that kind of thing. But you're right. There is no, going in to find an affordable new car that you actually want. That's sort of a unicorn right
Yeah, yeah, and unfortunately, consumers have gotten so used to, oh, I can, I
now.
can
We
get
looked at a
what.
loan application today that was competitively approved on it's a 10-year-old Lexus, like an ES, at 150,000 miles on it, and they're looking for 60 months, 5 years. And it's just like, and the customer is financially barely qualified for the balance of the loan. But do the math. The car's got 150,000 miles on it now. How much is it going to need to keep it on the road for in a period of time? If a lender, we didn't, but if a lender approves that for 5 years, how far does that loan have to sustain on the books before that lender no longer loses money on that decision?
Well, the
That's
average
at least
average
3 years.
yeah, average driver runs up about 12,000 miles a year.
Oh, way more than that up here now. Yeah, we're seeing routinely, 18,000 per year. Uh,
Wow.
oh, a lot more than we used to see. That is also true. But point being is at time of a loan origination at 150,000 miles, and arguably it's a Lexus, it's a Toyota product, so it's got that going for it at least. There's most of the other cars do not. So there's that. Um, but that, I mean, that
Well,
car's gonna have 250,000 miles on it by the time they're anywhere close to being paid for.
and at that point, most cars are either ready for the crusher or have long since gone to the crusher.
Yeah. I know. So that's the other, just
Yeah,
issue.
you're going to need
As
to put
Rob said, the
thousands
math
of
doesn't
dollars.
math.
Yeah, you're going to have to put thousands of dollars of maintenance into a car that has that many miles if you're going to hold on to it that long. But what I learned years ago when I was in the mortgage business, and I know and I was in the car business too. I sold Dodges and I
Yeah, I
sold
remember.
Kias and I sold Hondas. But people don't buy a price, they buy a payment.
Yes.
And at the end of the day, if you make the payment work for them, they're gonna probably sign. Um,
That's because they're renting it, not buying it.
yep. Especially now. And at least in the mortgage days, the theory was, well, you've got an appreciating asset. If you're going to create a subprime loan where they were paying at the time 15% on their mortgage or something like that, at least the lender had some confidence that they were going to be able to make good on most of the money, if not all of the money, if somebody had to walk away.
But one other thing we've had to do to just deal with the consequences of this economy we're in is there's this thing called collateral protection insurance. Because, if you're a younger driver, I mean, we've seen insurance quotes $600 a month. Um, for cars, we're not talking a Ferrari. That was like on a Nissan Altima, by the way. $600 a month. Okay. So if you don't have a pristine, perfect driving record for an extended period of time, expect, we've seen some ridiculously high rates, right? And so the end result is, we've got customers on the road who can't afford their ordinary insurance. And so what do we do? Well, our choices are, well, we can just turn a blind eye and hope that car doesn't get totaled and we take a full balance loss because the customer didn't have insurance. But if we're looking at an earlier term loan with a higher balance and the customer can't afford to get their own insurance, we've contracted with a broker who will underwrite what's called collateral protection insurance. And contractually speaking, we're permitted to add that to the balance of their account, the premium for doing that. And so instead of, here, this is happening right now, so you could go out and get your own insurance for 400 for your full coverage insurance from wherever, a regular carrier, or we could put collateral protection insurance on your account for 200. And like you said, they buy payments, right? So like, well, 200 is less than 400. Okay, fine, I'll do that. Keeps the calls from coming from us because you no longer have insurance. You're no longer in default from a lack of insurance standpoint, kind of. So the collateral protection insurance, though, only protects our balance in the account, and it is not liability insurance. So if you hit somebody else, it doesn't fix the somebody else's car. So if you get pulled over and the police officer says, I need your license and proof of insurance, you don't have proof of insurance because they want liability, is what they're looking for.
Yeah, because really you're the one who's insured, not
All
them.
right. So inevitably, we've had to add that coverage to more and more and more accounts just to preserve our interest. Um, And for those that still don't get the liability, when they get pulled over for a speeding ticket and they can't provide insurance or whatever because they don't have the full liability, we're seeing vehicles get impounded like crazy for that right now. And so it's just, it's
Which
just
is
one,
another crazy expense because we all know
yeah,
how expensive it is to get a car out of impound.
$1,500 probably
Yep.
between
The
fees and
towing company and
storage and all the rest. Yeah, it's
yeah.
expensive, and it just, I don't know. I don't,
It's
yeah.
hard not to lose faith, but you gotta keep plugging away.
Well, I mean, you got to have pretty thick skin to do this nowadays. And so, yeah, I mean, if, we've just as a little kind of a fun thing for us, we're kind of, we follow the Google reviews. We look at the competitive lenders who have Google reviews. We look at them all the time because, you're always comparing yourself. And most of the lenders in our competitive space, they range at around 2 out of 5 stars. But you're in the non-prime auto finance space, so that's about as good as you're going to get, right?
Yep.
We, as of the weekend, we got another review came in. We're at 4 out of 5 stars on our Google reviews in the non-prime, deep non-prime auto finance space. How is that possible? Because we bend over backwards for these customers, or forwards, whichever it takes, to take care of these people, to keep them happy until it hurts, and that is just the cost or consequence of doing business in this economy right now. If you have to take care of the customer like never before, because they'll turn on you
Yeah, and
instantly.
that's commendable from a business practice standpoint and being just a good citizen in your community. But I think it's also indicative of the fact that you are holding these loans. You are not farming these off and selling them to somebody. It's now their problem. If
Well,
it,
you want to know
if it's
another
a
fun
problem.
fact? Okay, you're a car guy, both of you. You'll appreciate this. There's an attorney who shall remain nameless, but anybody who knows the auto finance space knows that there is a law firm who is has a massive direct mail campaign to consumers where he pulls data. It's questionable as to where he's getting the data, but he sends notices to consumers who've bought used cars from area dealers and says, "You bought a car that we believe has structural damage, and we'll get you your money back. Just retain us as a law firm, and we'll get you your money back." And so we spend a lot of time dealing with the chaos from that. And we have one particular dealer who they have to indemnify us. That's part of the agreement when we do business with the dealer who sells the car to the customer, that they sign an agreement that if there's a lawsuit for lack of disclosure about vehicle history, that they have to indemnify the finance company. Fine. So that's standard. Um, Customer got one of these letters from the attorney that said that the vehicle had prior structural damage that was not disclosed to the customer, although the Carfax and the auto check reports were completely clean. Where this information was evident was in the auction condition report. Somebody who was doing the inspection on the car felt that there was something, nick on the frame, and they call that frame damage, and that wasn't disclosed to the customer, even though there's 3 reports. The industry's the NMVIDIS report that is required, but then there's the Carfax and auto check report. None of that showed any damage, except for the auction condition report did make note of something with the frame. So the lawsuit was filed by the plaintiff's attorney, and they were seeking many thousands of dollars in kind of, they called it compensatory damages and what have you, to the consumer. Anyway, bottom line is the suit went on for a long time. We won. The finance company, we had to retain our attorney to defend us in the suit, and the dealer had their own attorney. Our fees to win were still $16,000, and we won that lawsuit. Okay, because in the end, there was really nothing wrong with the car. There was nothing that wasn't properly disclosed to the customer, but it's just something that's going on.
But of course,
On top,
our system is set up so that even though you won, you still lost because you don't get to collect the $16,000 from the plaintiff's attorney for filing a bogus suit.
we can pursue the dealer who agreed to indemnify us for that, but most of these are small independent auto dealers and they can't afford that, and they're already a breath away from going out of business. So here we are having to defend ourselves against these malicious lawsuits for most of the time sometimes I will say, sometimes they're right, and we jump in on those quickly, and we tell the dealer that, look, you got to make this right. But this was one where there was no case. That the dealer did nothing wrong. But point being is the cost of winning is still ridiculously expensive.
No.
And that's just, this whole business just makes less and less sense all the time. So
And yet it's such a gigantic part of our economy.
it is because, okay, fine. Let's say we say, screw it, we're done. We're not lending money anymore. This is ridiculous. You know what? I mean, everything is against us. The auto industry, from a manufacturing standpoint, the service standpoint, parts and service costs, auto insurance costs, fuel, everything is working against us. Why bother? And right now, more and more companies are agreeing with that question as to, or a kind of succumbing to that question and saying, you're right, it isn't worth it, and they're closing. Well, fine. What then? Where are people? How are people going to be able to get? I mean, less and less competition is never good for the consumer. There's a few. There will come down to a handful of national lenders who survive, who are lending money their way, and it's just competition's healthy, but it's right now definitely on the ropes.
Yeah.
A lot of our healthier competitors have just given up. They just don't see the point anymore.
No. Well, Steve, I tell you what, we've been on for quite a while, and we so appreciate your insights and your generosity with your time to
No
tell us
problem.
what's going on the ground, and maybe down the road, if things start changing for the better, hopefully we can have you on again and we can get an update. But Fred, do you have any other questions? Any other thoughts?
No, no, I think we've pretty well covered the waterfront here.
Yeah, right. Oh, we could
All
go on
right.
for hours, I know, and I know nobody's got patience for that right now. But
Well, this may be a two-parter.
I
We
was
may
going to
have to
say,
break this. We may have to break this one up into two parts because it's to me. I've been fascinated. Actually, I've been really interested in getting your insights, and we talk fairly often, and you share little snippets. But for you to lay everything out together in a cohesive string, that was really helpful and really informative. And again, appreciate your time. So
absolutely.
with that, thank Steve for his time today, and we'll see you soon. Remember, please subscribe to the channel if you find what we talk about interesting and informative. Like the video, leave a comment. If you know anybody who's gone through the special finance world, good stories, bad stories, what have you, or if you have any thoughts on what's going on with the car industry, we appreciate your insights and your help. It helps the algorithm, helps us share this with more people who might be interested in it. So, with that, everybody, thanks a lot, and we'll see you soon.
see you guys. Have a good one.
All right. Bye bye.